Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I'm delighted to be joined by Tom Hibbert from our Chief Investment Office.
Hello, everyone.
Morning. And as you know, Tom is here to help me cut through the noise, demystify what's going on in the markets, hopefully in a simple and easy to understand manner, and then you can feel more informed, confident, and more in control of your financial future. So this week, Tom,
Yes.
we are focusing on oil because right now it seems it's the market's most direct pressure point. And the big question I'd like you to help us answer today, please, is why hasn't a $100 oil price triggered the kind of panic we've seen in the past? And really, what should investors actually do about it? So grab your coffee. You've got your coffee? And let's dive on in. So as I say, mainly talking about oil and oil prices this week. This seems to be the most immediate transmission channel, they say, from the Middle East conflict into the market.
Yes.
Prices have moved from about $60 a barrel to about $100 a barrel. And I think we would say they are surging rather than spiralling out of control. And I saw that some commentators have noted that the move still looks contained relative to the scale of the disruption and also compared with historical shocks.
Exactly.
And I know that you put in this week's Weekly Markets Review that the 1973 Arab oil embargo removed roughly 5% of global supply, but drove a 400% price surge. So this is very different from that situation.
Yeah, it's a bigger share of global supply that goes through the Strait of Hormuz. It's 20%. It's a fifth of global supply that goes through the Strait of Hormuz. So it's a much bigger shock and
a much smaller price.
But a much smaller price shift that we've seen.
Yeah.
And there's a few interesting reasons for that. The first is that supply has been disrupted. But it hasn't completely disappeared. It's been quite an adaptive market.
An adaptive market. What does that mean?
In that Saudi Arabia, the UAE, they've found alternative ways to sort of reroute what would have previously gone through the Strait of Hormuz. So they've pushed alternative pipeline infrastructure to capacity,
right,
effectively, and that's diverted flows away from the strait. So what they've managed to replace is about 7 million barrels per day, which is about 35% of the supply shock. So that's dampened the supply shock. That
previously went through the Strait of Hormuz.
Exactly. So 7 million barrels a day is compares to about 20 million that was going through the Strait on a daily basis. Second, that we've seen, a lot of emergency supply from strategic reserves. We've seen strategic reserves being released into the market, which has helped dampen the supply shock. And also, there's been this policy flexibility particularly from the US, to accommodate sanctioned barrels from other countries. So sanctions on Russia have been softened, for instance,
so that they can then sell their oil globally.
Yeah, and that's injected additional liquidity into the market.
No pun intended.
No pun intended. And then you've got this. There's the global price for oil,
right?
Which people tend to look at the nearest sort of futures contract.
And then, hang on a minute. The what?
Yeah, the nearest term futures contract.
The nearest.
So it's not the point is it's not the physical market. It's not the spot market today. It's not like you go into a shop and buy oil.
Yeah. Okay.
If you try and do that, you buy oil today in some sort of specific location.
Yeah.
It might be much more difficult than the price that you see on your Bloomberg terminal, $100 a barrel.
Okay.
And we've seen that. So physical markets, particularly in Asia, have been a lot tighter. You've seen prices up to $260 a barrel, buyers paying substantial premiums to secure this very sort of limited supply.
Okay.
And I think that's the key. So global benchmarks and the futures that people look at understates the severity of local disruptions in the spot market.
Okay, I think I get all that.
And then finally, you've got this saying that the cure for high oil prices is high oil prices. In that when you have high oil prices, it constrains demand.
Okay.
And if you've got lower demand for oil on the back of that, or high oil prices, for example, might trigger a growth shock, you have lower oil prices on the back of that.
Yeah.
And we've already seen the International Energy Agency lower their expected global oil demand for this year.
Okay, so things that they're talking about, fewer air flights, less air travel, that sort of thing.
Yeah, those are a few good examples. Exactly.
So what about the other thing I was hearing? So there's a supply and demand, but also that there's simply less energy intensity than in previous decades, therefore not quite the same shock as there would have been in the 1970s. Does that make sense?
Yes, and in fact, I think that's the most important point. Actually.
Okay, is that?
So people are saying now that maybe $150, maybe $200 for oil is the new 100. The price that it takes for it really to trigger a global economic slowdown, which is why we haven't seen the panic across markets. We've got an elevated oil price. But because the global economy is less energy intensive than in previous decades, we've got a more diverse source of energy supply.
Yep.
We're less oil reliant.
Okay.
That actually it takes a much higher oil price to trigger the same sort of slowdown as we may have seen in the 70s.
So what would make you sort of genuinely more concerned from here? What indicators are you watching most closely?
Sure. I think the key thing has to be inflation. And we're already seeing inflation pick up on the back of this.
So the energy shock is feeding through into inflation.
Inflation, but it's feeding through purely in energy prices. I mean, energy prices are direct into inflation numbers. So that's where the concentration is. The real worry is if you see that broaden out into other areas. Yeah. So into the demand side in particular. So
which we've talked about, the supply side and demand side on the podcast in the past.
Right, exactly. So if we start seeing wage growth really pick up, or if businesses who have obviously energy as a key input into business costs, will businesses put their prices up for their products? And that is a concern. There's less of, they'll find that more difficult because the economy was already slowing, demand was already quite constrained. Consumer spending was not quite reasonable, but wasn't as sort of hot as it was in previous periods of inflation in recent times. So there's less of an obvious transmission for that to happen. But that's something that we're looking at, and we're already seeing inflation now. Inflation in the UK rose to 3.3%. Last week, up from 3%. But as I say, all of that so far is attributable to energy prices.
So core inflation relatively contained at the moment, and longer term inflation expectations still fairly anchored.
That's the other key point, actually. So if you look at why the general view is that this is a sort of transitory energy shock, because the demand side of the economy is still quite weak and slowing.
Got it.
So if you look at the market expectations for inflation, the market still sees inflation undershooting the Bank of England's 2% target over the medium term.
So talking about the Bank of England then, what does this mean for central banks and interest rates? Any impact?
Yeah, there obviously are, because previously central banks wanted to cut interest rates and were sort of progressing with their easing cycles. This has thrown a major spanner in the works for most central banks, and they're now going to find it much more difficult to cut interest rates in the face of an obvious inflationary impulse. So we've got a whole host of central bank meetings next week. We've got
you'll love that. You love a central bank meeting, don't you?
Love that, I do. We've got the Bank of England, we've got the Fed, we've got the ECB, we've got the Bank of Japan. I think we've got 10 in total.
Okay, that'll keep you busy next
Canada.
week then.
So it's all happening. And the general pattern that we're seeing is that central banks are now just on hold.
Okay.
So their rate cuts have been delayed.
Right.
But I think the bar for renewed tightening, that means what it'll take them to start raising interest rates again, is still very high. Okay. Given the fact that this still looks very much like a supply side shock. And I think as long as inflation expectations, we're watching those medium-term inflation expectations, as long as they stay anchored and those second round effects are contained, this is more likely to slow the pace of easing rather than reverse it back to interest rate hikes. And then the last thing I'll say is obviously there's a lot of uncertainty around the ongoing there's ceasefire at the moment, but it's very fragile. We could say Schrodinger's Strait of Hormuz, because no one knows whether it's open or closed.
Oh, okay, yeah.
It's simultaneously open and closed, supposedly. But as long as a resolution to the conflict and everything that's happening in the Middle East is elusive, bond yields will still stay elevated.
Okay.
And we're seeing that in the UK and Europe in particular, which are most sensitive to this energy crisis. And also, as long as the conflict continues, the probability for more structurally embedded inflation is increased.
Okay.
So those are the key concerns.
All right. Thank you. Well, thank you very much for your time today. Let me sum up what is in my Canaccord takeaway coffee cup today. So we talked about oil prices being higher, but not necessarily disorderly. Markets are more adaptive, you said, than in past crises. That means they can adapt more because they can get supply from elsewhere, turn on a few more taps.
Yep.
Inflation impacts are being closely watched but remain contained. Central banks are cautious but not panicking. And you're looking forward to next week's meetings.
I am.
And overall, I think what we're saying is perspective matters really more than the headlines at the moment.
I think the key message is it's reassuring how adaptive the market has been and how robust the economy has been on the back of elevated and not spiraling oil prices.
Yeah, makes sense. So as ever, I think this week's another good reminder that portfolios need to be built for resilience, diversity, just to accommodate these sort of things going on in the world.
Absolutely.
So thank you again for listening to the Canaccord Coffee Break podcast. If you've enjoyed it, don't forget to hit follow on Spotify or Apple or your podcast channel of choice so you never miss an episode. And as always, we'd love to hear your thoughts. Drop us an email, coffeebreak@canaccord.com. Thank you.
Thank you. Thank you, Jane.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.